Our
Or,
original
well,
hour.
no, not our original hour.
We were 9 to 10 was our original.
Right.
Was it 10 to
10,
11?
it was 10 to 11.
Okay, so you're sleeping and we're not awake, so life is good.
Right.
Our phone lines are open. We'd love to hear from you, 931-5877 or 84126 from the quiet but usually busy text line.
So I had a coaching session this week with the sister of a client, and this is pretty cool. Her name's Karen. They're originally from Maine, and actually Karen still lives in Maine, which is pretty cool. So it's our first Maine client.
It's cold in Maine.
Yeah, I heard it gets cold enough up there that like the windows break.
It's cold in August.
Okay.
It's cold.
Oh my gosh. All right, it's cold. But not for Karen because she's looking to retire. So
That'll
right.
warm you
It's
up.
always summer when you're retired, right?
We love that.
So Karen's 64 years old. She works for the state and she loves her job, but she doesn't so much love her current position anymore. So she's kind of looking to move on from that. She's looking to retire in March when she turns 65. And she'll be eligible for Medicare. She'll be eligible for her pension. So she likes how that all lines up. But she'd also like to get a part-time job to pay off her mortgage. Because she mentioned that carrying the mortgage balance into retirement was a concern of hers. She felt it made up a lot of her income, and she kind of wanted that off of her plate.
Yeah, that's kind of curious because since, I guess my question was, since you did this with Karen, she's getting a pension from the state, which means that she probably doesn't have a lot of Social Security earnings.
Well, she doesn't get any Social Security because she paid into the state pension. So this particular pension works similarly to that of like peers, which would be the teachers' pensions here.
So is she also then, because she's under her normal retirement age, which would be 67, she's not going to be affected by part-time work or even full-time work if she takes it?
No, because pensions aren't subject to income limitations, and her full pension benefit is eligible to be collected when she turns 65, which is why she tried to line that up with March.
Cool. So she's got basically a leg up on other folks.
Exactly. And really, I thought this was an excellent plan. Most of the people that come in to see us are natural planners, and but what I wanted to do was be a little bit more conservative for her, which was, what if you don't find something that you like in part-time work? Or what if the part-time job you find doesn't cover the full mortgage? Let's see if you're still a rock star, even if we have to carry the mortgage into retirement.
Cool. Good thinking.
So we know that, we know because she told me that
Hidden knowledge.
Right. She needs $6,000 a month. That's how much she's spending. And that's before taxes. So we have to gross it up for taxes, which means she really needs about $7,200 a month. Her pension is going to be $5,000 a month, which means she's got a deficit of about $2,200. $7,200 that she needs gross, which incorporates taxes less her pension amount, gives us $2,200. If I had a lump sum of capital that I wanted to pull about 4% off of, which we believe is prudent, she would need about $660,000 of assets to maintain that over the course of time.
And that's really what we think of as the milk money.
Exactly. The cool news is her retirement plan assets total $825,000. Which means she's, exactly, you put right before, she's a rock star, even without the part-time job. You're really already paying your mortgage with cash flow, or she's really already paying her mortgage with cash flow, and so she'll have enough with her pension and her assets to cover all of this over. But here's the thing, and this happens really frequently, which is I feel like these coaching sessions are kind of like an onion. You just keep peeling things back.
Right.
And so when I said this to her, she revealed her family math to me. And we talk about family math often, which is another way that our clients are often planners before they know it. They have their own buckets of money, the way that they devise how they're paying for things. So Karen let me know that she had sold a property several years ago and was literally held the proceeds of that sale in a savings account, and she was paying her mortgage separately of $2,000 a month with the balance of that $170,000 which she netted from the sale of the house.
Okay. So she was basically using one piece of capital. She was consuming that capital, much she didn't love to.
Exactly.
To basically pay off that mortgage. So she already had basically the road was there. It was there. She was paving with money. So, okay.
Exactly. But this was going to be exhausted by the time she retired, and she still had that $2,000 a month mortgage. And if we use that same math, if I need $2,000 a month and I have a lump sum of capital, I'm going to need about $600,000 in order to maintain that payment every month.
Yeah. So like I like to say, 600,000 of her 825,000 is really being held hostage to pay that 2,000 a month of mortgage debt.
Right.
I mean, that's really the reality of it. So the question becomes, okay, does it make sense to torch this thing?
Exactly, because Karen hadn't originally added in that mortgage payment to the $6,000 a month she was spending.
Ooh.
Right? So I asked Karen, we use the net spending of $6,000 a month, but are you really spending that? Because she's a single lady. She's got a $2,000 a month mortgage payment. I was thinking like $6,000 a month sounds like a lot of money to spend every month if you're not incorporating that mortgage payment into it.
Or your mom.
Right. Amazon was getting a lot of money in this case.
Absolutely.
So I said, are you really spending $6,000 a month? And she let me know what she was doing. She says she sends $1,000 a month to her savings account, and then she sends another $1,000 a month to her investment account,
which she's sending back out to pay for the mortgage.
Through a different account.
Right, literally.
So she's building it back up again as she's spending it, but she's doing it with different buckets.
That's
so.
Well, I mean, it's curious to see people's thinking. And that's really what it was she's sending out $2,000 from account A, she's draining, but then she's sending $1,000 to two separate different investment accounts. Literally, it's A to B. Right.
Exactly. So since I knew Karen obviously was a great saver, she had accumulated $825,000 in assets. We really just discovered that she was saving extra every month, like you said, Dad. And the reality in retirement is we don't have to save. We just don't spend what you have already saved. So the cool thing is really that $2,000 a month mortgage payment was actually incorporated into the $6,000 a month.
Yes.
It was just incorporated in a slightly different way.
Yeah. So what happens is you were able to show her that she truly had the freedom to work or not work, but that her income flow would be there and something she could depend on. And frankly, it put her in a position, I think, to make some better choices about not only when she wanted to work and how she wanted to work and how long she wanted to work.
Right.
And that's great.
It was really cool to be able to let her know that, like, the way that she had created the family math, we just reoriented her thinking a little bit, and she was able to, like you said, Dad, feel really comfortable in that, maybe we are carrying the mortgage a little bit longer than she planned. And also it gives her the freedom, like you said, Dad, she gets to choose the part-time work that she wants to do versus having to find something to do.
And it's curious here, honey, because this sort of comes down to the essence of conversations that we have with folks and really what they have to do internally.
Right.
Having the cash flow to maintain a payment obligation, whether it's a loan or a mortgage, etc. In retirement it's tough. I mean, it's tough to make those decisions. If you have the cash flow, you don't have to kill the debt because you have the cash flow.
Right.
That will obviously eventually eliminate itself, or you'll die. Well, no, I mean
that's another way to eliminate debt.
Well,
right.
I mean, let's have a little fun here, but I'll use a real life example. As you know, I have a mortgage.
Right, you had like 15 minutes of your life with no mortgage.
Exactly. I have a mortgage against a home that I built about your mom and I do, even though she says it's mine.
Well, you're the only one working.
That we built 7 years ago, and I did a 30-year mortgage at the time.
Right.
which is kind of silly if you think, 55-year-olds doing a 30-year mortgage, but the answer is no.
Because you amortize the payment over 30 years to make it manageable.
Right.
So you could choose to. Also, that becomes a question of interest rates, right? Like, you obviously have a lower rate since you had it 7 years ago. Well, if you've got a higher rate now, maybe you're considering paying it down faster. But if you're somebody that's got the 3 or less % interest rate, why pay it off faster?
Well, the other thing is, at least for me at the time, I really wasn't certain if I had an income stream that could continue for as long as I did. But then you showed up.
Oh, so I'm like a personal pension.
Yes, one of my favorite personal pensions. But what happens is, right, I mean, I know the cash flow will be there. The practice will continue on, which is fine. I'll continue to work at whatever level that you permit me to. And it's just going to be kind of fun.
We'll review that during your annual review.
Well, I know there's sometimes it can get shaky. But if we are in a situation where we decide, your mother and I decide, say, hey, maybe let's get rid of this obligation. We can certainly accelerate the payments that we're making.
Sure.
We could do a refi.
Not now.
Well, not today. I mean, interest rates will eventually go down, and they're not as high as they've been, forever in the past, even though it sounds like, the truth is, it's nightmare levels.
Well, I mean, for people that...
Well, it is 6%. Look, I mean, 11 months ago, we were 4% lower.
Different world.
Well, and also this perspective is a lot different. Younger people buying houses now never experienced 16% interest rates.
Yeah.
So 7% to someone that was at 16 sounds like a dream, but 7% to someone that was at 3 sounds like death.
Well, it makes it difficult to qualify for stuff at the bank, and that's fine.
Right. You get half the house.
But you know what's not difficult to qualify for?
Listening to the next hour of the show.
Listening to the next hour of the show.
You're all qualified.
You're all qualified. We certainly would love to hear from you.
This is a hypothetical situation based on real-life examples. Names and circumstances have been changed. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments or strategies may be appropriate for you, consult your advisor prior to investing. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. Insurance products offered through LPL Financial or its licensed affiliates. Robert Markham is solely an insurance-only representative and does not provide any financial advice or services.